What's up, Gould Miners? Today we welcome Matt Burk to the show. Matt is the CEO of Fairway America, a real estate investment firm that has a multitude of real estate funds under their management, spanning across a wide variety of real estate sectors. Matt launched his first real estate fund in 1999 and has over 3 decades of real estate investing experience. So needless to say, this man has a plethora of knowledge and wisdom to draw from, and he drops it all in this episode. We start the episode by talking about Matt's early days as a private real estate lender and how he eventually was able to launch his first real estate debt fund in 1999. Later on in the episode, Matt shares some of the changes that he's seen in the fund space over the last 3 decades for both fund managers as well as LPs. He also shares some advice for emerging real estate fund managers who are getting their start in 2024. We wrap up the episode with Matt talking about the future of real estate investing and the key opportunities he sees in the current market. Matt is truly the real deal. He has weathered the various storms that have come about over the last 3 decades and runs a tremendously successful real estate investment fund. So I cannot stress how much knowledge is dropped in this episode. So without further ado, everyone, let's welcome to the show, Matthew Burk. Matt, welcome to the Gould Mine.
Danny, thanks for having me.
Of course. And the audience is just tuning in right now, Matt. They're at home. Why should they stick around? What do they stand to gain from listening to your story?
Well, if they're in the real estate business, raising money from investors to fund whatever deals it is they're doing, I think I have a lot of experience and insight and background on how that works and funds and syndications and a pretty broad, long history of doing it. So I think there's hopefully something that is new to them that they can learn from.
That's awesome. And obviously you have a fund, you manage the fund. That's Fairway America, correct? So can you explain what that is for the people that are listening back at home that might not know what Fairway is or what you do exactly?
Yeah, well, I'd say our business is pretty broad. Danny, we do quite a few things, but on the investment side of the business, we have managed private 506 Reg D real estate asset-based funds for many years. So the first one back in 99, 2000, I guess it was, we launched it, and we're on our 11th or 12th now. So yeah, we've managed private real estate funds for a long time.
Got it. And the majority, is it diversified amongst various real estate asset classes, or do you focus on one specific sector?
Yeah, I think each fund has had a different kind of a structure and mandate. I think in the early days, the first 4 or 5 of them were credit funds. So they were real estate secured liens, first trust deeds, some seconds, et cetera.
Okay.
In the day. Since that point in time, Danny, the last 10 years or so, they have been broader. So the mandate has included, we still do loans, and there's loans in there, but also investments in other private 506 Reg D funds and investments in both LP and GP equity positions in individually syndicated deals, or maybe we take the entire equity stack depending on the deal size. So yeah, some of the later ones are more diversified. There is a couple others in there that were pure equity that were focused on a very specific strategy. One was self-storage, one was industrial, one was multifamily. So it kind of depends on the fund as to what the strategy was or is.
Gotcha. Okay. So you are investing in equity positions also, or like LP positions, you're investing in GP positions as well, correct? So you're kind of taking both sides, taking down both sides?
Both of those, yes. A lot really depends on the circumstances. I'd say our focus, Danny, is in we'll call it the sub-institutional space. I mean, smaller deal sizes where the large institutions or funds aren't as interested because the deals aren't quite big enough. I think that has been a theme of everything we've done, right? It kind of is a more fragmented market, like less efficient, less of the big players that are in there. So we focus on that. But we've done storage, industrial, retail, a variety of different types, and we've done a lot of real estate loans.
Gotcha. Okay. Now, that diversification, obviously, there's benefits to that. One thing that comes to mind right away, as in like from an LP standpoint or from an LP perspective, is Okay, great. You have all of these different asset classes or basically investment types that you're making. How do we because we're not specialized, how are we ensuring that the fund itself knows how to operate or understands each individual investment type? Does that make sense? So how are you ensuring that? Obviously you have a real estate background. I'm assuming you have partners, they have real estate backgrounds, but how do you kind of reassure the investor that their investment is safe, even though there's diversification as opposed to specialization?
Yeah, and I think if you go back in time, I think we cut our teeth as lenders, right? So we have underwritten all different types of real estate in terms of how they are valued, how they function, et cetera. So the early days, the first 15, 20 years of my career was involved in underwriting real estate deals. That gave us a great deal of breadth in different types of assets, right? And then over time, we have branched out into partnering with various local and regional sponsors, right? So we go in, we partner up with other people who have a specialty in one area or another. And then the combination of what we bring to the party for them and what they bring enables us to really make sure that we have the expertise on that particular asset type, right? So it's a combination platform, Danny, where we partner up with people around the country, and it's a longer story than that. I if you want to go into it, we certainly could, but we've done a great deal of work over the last 12 years now, helping other fund managers that were similar to me that went from doing one deal at a time into a pooled investment fund, helping them think through and structure those funds. And it's through that advisory work that we create the relationships that we end up doing deals with, right? So we find what I would consider to be best-in-class sponsors around the country who are specialists in one area or another. And then we work with them to help them create their own pooled investment funds and help them capitalize those funds.
Gotcha. And is that a vertical of the Fairway America business, or is that a separate business?
Yeah, it started, well, we have three different entities, actually. We have Fairway America is kind of the mothership. That's the investments business. Fairway spun out a company a number of years ago called Verivest. Verivest is a fund administration platform and advisory. So it does the advisory work for sponsors, syndicators, private lenders to help them set up their own fund. And then it does the back office accounting and fund administration for those funds once they get up and launch. So that's a separate but related entity. And then our other platform is called Fund Sommelier. It's fundsom.com, fundsomm.com. And that business is a capital raising service where we help managers take their funds to market and raise more capital from investors and do a lot of the back end work for them. So it's a combination platform, Danny, that's grown over the years. And we started off as an investment manager, as a lender, and we've expanded over the years into advisory admin and helping other managers grow and scale their fund business.
Yeah, that's awesome. And obviously having all that experience and everything, you're bringing all of those systems, processes to the table. Are you acting in an advisory role and taking and this is just for my own education, right? So are you taking a fee, or are you taking are you participating in the deal as the GP? How does that typically work?
Yeah, it does vary. I mean, the fund creation work, if a manager comes to us and wants to set up a fund, that's just a flat engagement, right? So it's a fee, but it's not a carry, right? If they come to us, they want to do the administration, that's an ongoing percentage of assets under management, but that's a back office service. If people want us to help them raise capital, we run everything through a broker dealer. And so there's a commission charge to that. And then we'll take a back end piece of the manager's portion of the compensation for whatever capital that we raise. If we're investing in another manager as an LP or a GP, it really depends on the economics of that deal. Sometimes Danny will come in as just an LP on a deal, depending on the size and who the manager is. And other times we might come in and put up some of the GP capital. Let's say if they're going to go out and get an institutional LP, and then we'll participate in the GP economics with them. So it really depends on the manager, what stage they're at in the evolution of their business, and what their needs are.
Yeah, that's awesome. So coming back to your like initial fund structure and like what you guys were doing, that makes a lot of sense to me, right? So you basically spent a full cycle, it sounds like, underwriting a variety of different and lending to a variety of different commercial asset classes. As were you the primary lien holder, like first position, or were you doing like?
Yeah, in the early days, it was pretty much all first trust deeds, and I would call it hard money lending for commercial real estate. So it was for whatever the borrower could not get a more traditional bank loan, and we would come in a first position. It's either maybe as a credit issue, it might be a vacancy issue, it might be a partner issue, a tax issue, right? Things like that. And we would take a senior position. I think as time has worn on, we have done and will do some pref equity or mezz positions, right, on certain deals, depending on how much equity there is in the property. But I would characterize us, Danny, as we're real estate people through and through from the very get-go. I do have partners in the business. There's 4 of us. And then there's a few outside shareholders, but mostly it's the people that work here as the executives. All have a very deep real estate background in one way or another. So I think one of the differentiators for us when we help people set up funds is we have been a fund manager. We are a fund manager. We're practitioners of it. We're not, ivory tower theorists or bringing. Lawyers are generally the ones who draft the documents. And you have to. Securities lawyer is table stakes, right? You have to have a counsel who knows what they're doing. But oftentimes, counsel hasn't run a fund. They don't necessarily understand all of the interconnected parts of there's origination, there's asset management, there's capital raising, there's investor relations, there's legal, there's accounting. Right? They all have this confluence effect that you need to understand the interconnected parts. That's what we help managers, through when they're setting it up to hopefully set it up properly in the first place. Because there's all kinds of things that they don't even know what they don't know, right? Because you can't know until you've gone through the whole process. So, and then that also serves as our origination platform because everybody wants and needs capital. So when we find shares we like, then we'll talk to them about, right, how do we do deals together?
Yeah. No, that's a really awesome way. And I like how you've like created 3 verticals, right? So you've got your fund, and then you've got the capital raising component, and then the fund admin component. And you almost see, it sounds like you use the fund admin component to almost vet the sponsors, find the ones that you like, and then start partnering them with the capital raising.
We use the advisory component to do a lot of that, right? Because we get to know them and we're asking a lot of questions. So Danny, what kind of a fund do you do? What's your asset strategy? How do you underwrite? Who is your team? What kind of investors? Who's your investor target base? Like what size are they? How do you match that up? And then through that process, you're right. We get to know them, we get to understand, and then, hey, we really like this person. Right? There's somebody there. So they're there. The admin is after the fact, right? Because after you launch, a lot of this is what happens to a lot of people, managers. You launch a fund. Most real estate people they're not accountants. They don't really understand the application of pooled fund accounting, where you're ascribing, you're allocating income and expenses to investors who are coming in at different points in time when assets are coming in at different point in time. That's not something most real estate people know how to do, right? So being able to do it well, though, is important in terms of being able to engender confidence with investors when you're raising money. So fund administration is a business that has really grown in the last 10 years. We started doing it. There wasn't a whole lot of people that did it. It's always been sort of table stakes in the institutional world. If you're these huge, Blackstone and BlackRock and Carlyle and groups like that, they all have a fund administrator. But when you get down into the small balance world, under 50 or 100 million bucks, that used to not be a thing for fund administration companies, but it's more and more a thing now, because if you're a private investor, you want to know that the books are being done, properly, and that income allocated appropriately. So, we started doing the admin side. That does give us a level of comfort that when we're partnering up with people, that we know that, everything's being accounted for properly.
When you say sub-institutional space, you just dropped the 50 to 100 million fund size. So in terms of asset size, though, Are you looking at that as like a volume, like a dollar amount, like under 10 million, under 20 million, or are we talking like size of property? Like, I'm assuming that you're looking more at it like from a volume perspective, right? Like, okay, it's no more than X amount of dollars typically.
Yeah, I would say there is no sort of magic, cutoff number. And I think it depends on what you're applying the number to. When I threw out the 50 or $100 million number a moment ago, I was referring to total assets under management in a fund, right? Now,
I
if
see.
you did
Okay.
a single deal for 50 million or $100 million bucks, right? That's plenty big for, attracting, let's say, a JV LP partner that wants to come in and write a 20 or 30 or $40 million check, right? There's a lot of groups that want to do that. So on a single deal, I would say, maybe below 15 or 20 million total capitalization is hard to get the attention of a big player. You get up to 50 or 100 on a single deal. There's lots of people that, would look at any sponsor to come in for the LP portion of a deal like that on a deal by deal basis. But in a pool fund, like anything below, frankly, even 250 or 500 million is considered small in the fund world.
Yep. Makes sense. Now, you got into this, you said something like you got into real estate and finance by accident. So how does that work?
Well, I think I didn't really know what I wanted to do coming out of college. I was an economics major and, I went and found a job and I ended up going to work for a consumer finance company that did sales contracts, personal loans, and it did some real estate loans. And I'd say, and as I just trained at that company, I found that, the real estate piece was interesting to me. I mean, I see the property, getting appraisals, how you determined what that value looked like. So I kind of gravitated toward the real estate finance section. I was at that company a couple of years. I went and I found another job with a company that did nothing but real estate, started focusing heavily on the real estate side of the equation. I moved from California to Oregon in the early 90s to set up a branch office for that group. And then about a year later in the early 90s S&L crisis, which you're sure way too young to remember, they shut down a lot of their offices and I was kind of without a job. So in my late 20s, I sort of, I either go back to California or go find another job or I kind of start my own thing. So I hung out my shingle and, I was 27 years old, I think, and went for it. So I'd say it was accidental in the sense that I didn't have some master plan to be a real estate person. But, once I got into it, I found I liked it and, the company shut down and started my own company.
Yeah. And honestly, because when people hear the story, hey, I just started the fund, a fund in 99, right? And here we go. But it's cool to hear kind of like what the background was. So it sounds like you had like plenty of exposure.
Oh, yeah.
To real estate before you got into the fund space. And I think there's a lot of people who have zero knowledge and then they want to start a fund and it's that doesn't necessarily work out very well.
And I get those people, man. I mean, they call up and say, hey, I want to set up a fund. And I go, well, have you done a syndication? No, I haven't done one. Well, and do a syndication or 2 or 10, so what you're doing first and then think about setting up a fund. But yeah, I mean, I started the company in 92 and we didn't launch that first fund until 2000. So that was 8 years of doing individual trust deeds, matching up investors in one deal at a time. And then, and that's the typical progression I find, Danny, for a lot of people is that they, matching up one deal, one investor or one deal, multiple investors at a time gets cumbersome. I mean, it's time. Yeah. So at some point you go, well, hey, if I had discretionary capital and I could, take advantage of the deal quicker, and that's when people start thinking about a fund. And that's kind of the stage at which we catch a lot of these folks and say, okay, does it make sense or does it not make sense? Now, a lot of them, man, I tell people, I mean, I'm a very straight shooter. If I don't think it makes sense, I'll tell you, hey, I think you're better off to just keep doing them one at a time or whatever.
Interesting. Okay. So 7 years, it sounds like almost 8 years you spent syndicating deals, right? Doing them doing one-offs. And then you launched Fund One.
That's correct. And in our case, this is, we didn't even syndicate them. We were doing pretty small deals. I'd say under $1 million. So we would almost always match up one investor and one deal. I mean, if I had a borrower that needed 200 grand, I'd find the single investor that had 200 grand. We'd match make and we'd keep points and we'd charge a servicing spread and we'd collect it, make it easy for the investor, and they'll charge the borrower 12 and pay the investor 11, keep one, and do all the work for the investor.
Awesome. Okay. That makes a lot of sense. Now, obviously, things have changed since then, right? Because you started in the 90s and now we're... So how have you seen things progress? Like how has the fund space evolved over the last couple of decades?
Well, dramatically. Lots of changes in those times. I mean, fundamentally, I think making good real estate investments similar to what it has always been, but the Jobs Act passed in 2013. You can now publicly solicit and advertise. I mean, back when I started, you had to have a prior business relationship. So I think it's the internet has obviously changed things, and now you've got AI coming down the pike, and it's changing things even more rapidly. Technology and automation is probably the biggest change. I mean, people can find it on the internet. When we started doing this, I mean, you print out documents and put them in a FedEx thing and put a little sticky note on them and tell people to sign there and send it off. And then they'd FedEx it back, and then, oh shit, they forgot to, sign in the right spot, and then you'd have to send it back to them. And, now it's, you do a DocuSign and they sign in seconds, right? Everything's digitized. Back then it was all, analog offline. That's probably the biggest change.
Interesting. And in terms of like investing styles, do you think stylistically, like meaning, do you think that funds have changed dramatically in the way in which they size deals, they look at deals, or pitch deals to investors? Like, how are you seeing kind of like the day-to-day of the funds and their business models? Is there a big difference between then and now?
Yeah, I think there's a lot more variety than there used to be. There's a lot more funds than there used to be. I think it's a lot more prevalent that people know about it. I think a big part of that, because you can get information at your fingertips that, it took me months or years to learn a lot of the stuff that we had to learn about what a fund even was. How does it work, right? Had to hire lawyers, and it was a cumbersome process. Today, there's massive amounts of information, online that you can find, and service providers, every which way that'll help you. So it's a lot easier than it used to be. I think stylistically, you'll see a lot more funds that do certain things that back then I don't think they did as much of. I mean, you'll have a retail fund, an industrial fund, a storage fund, right? And you didn't see nearly as much of that back in those days. You'd see a few, but not nearly what you see today.
Interesting. Now, I'm assuming that your fund still kind of invests in a multitude of asset classes. Are there any sectors that you're shying away from right now?
It depends which fund. I mean, some funds we like are open-ended, diversified funds. They have a very broad mandate, so they can invest in, a lot of different things. Some of the more asset-specific funds, storage fund, for example, I'm asset limited strictly so it depends on the mandate.
Yeah.
I think we have tried to stay away from, certainly haven't done much office. Thankfully, that's a tough asset class. Although I do know a few fund managers that are done extremely well with suburban office, right? So the thing I find about real estate that's a little off topic, but relevant, is in the sense that when you just use the term office, right? That's a pretty broad brush. If you're in a, downtown CBD office tower, that's totally different than if you're in, walk up suburban, kind of standalone office, right? Because that stuff in many markets is doing extremely well. So I think I like the fact that there's a lot of different ways to skin the cat, and it really depends on the individual manager. And over the last 10 years, I've met managers all over the country that have, what they believe is their secret sauce on how they make money in real estate. And, for good operators, there's always opportunity in just about any market.
Fair enough. And you know what? I think that I would more or less agree with you. If you look hard enough, there will be opportunity. I think that like people like to kind of broad strokes say, oh, like this sector's dead or this isn't a good sector to invest in. But like the truth is like the deals are out there. They might be harder to find.
Yeah, there's so much more information available now. That's another way I think the business has changed. You talk about, I mean, it used to be like people could, bird dog things, and you had to work really hard to get the information and find off-market stuff, and there just wasn't nearly as much information readily available. But if you're a seller today, like you got to kind of be crazy not to just go online and be able to get quite a bit of information about what your property's worth. Right. Whereas today people could, I don't want to say take advantage of, but like, if a seller's doesn't really understand what they've got, or the buyer's got, a way to add value to that quickly that the seller's not aware of, you can have a disparity of price immediately and you make money on the buy. Sure. It's a lot harder to do that in today's world than it was, in the past. I think, but there's a lot more opportunity. The volume is so much higher because there's so much more activity, and it's so much easier to get information than it used to be.
Where do you see this going? Because, I was talking to another guest where, he basically like equated it to like, like guess the tune, right? So it's like, hey, like someone, guess the tune in 6 notes, and then someone like says, no, I can guess it in 3. And then like, someone's like, oh, I can guess it in 1, and it's like, no, you can't. Right. And I was like, that's really interesting, so, at some point that model kind of breaks, and it seems to me like we had the kind of like the perfect storm of that plus rates all at once. And so I'm just curious what you see on the horizon right now, because for the last year, it's been like, oh, there's going to be blood in the water. There's going to be blood in the water. But like, is there really any blood in the water? I mean, I know that people are struggling right now. There's definitely like, keys being handed back to the lender, but not at the scale I think that we all expected it to, expected there to be. So like now I'm wondering, is it ever going to get like that, do you think? Or are we waiting for something that might not ever happen?
I felt that way after COVID, right? When COVID happened, I thought there's going to be blood. I mean, this has to be the downturn, right? And then you had to shut down, and then the Fed started pumping money into the system, and then it took off like a rocket, right? So, but I think the rate increase definitely had a much more negative impact on real estate than COVID did, other than perhaps office, right? Which is fundamentally changed based on, human activity and the way people into the workforce and such. Short answer, man, I'd say I do think there's going to be plenty of blood in the water. I think you're already seeing it. I mean, we certainly have, assets in our portfolio that, with the benefit of hindsight, I wish we hadn't done, right? That you bought at the peak of the market. And I think depending on what sector someone's in and what asset type they were pursuing, it's going to be more or less pronounced depending on those factors. But you're seeing, a lot more pain than you saw after COVID, certainly in the real estate world. And I think in some sectors, you're seeing comparable pain to what you saw in 2000, 9, 10, 8, 9, 10, in that aftermath of the Great Recession.
Over the next 5 to 10 years, where do you see, and I feel like you're one of the, a really good person to ask this question, because you obviously have exposure to a wide variety of like sectors. Like, where do you see the biggest opportunity right now? The most amount of opportunity sector wise?
That's a great question, man. And I think people who have access to knowing how to take advantage of special situations and buying into opportunistic scenarios probably have the most opportunity currently. I talked to this morning, for example, that's looking at setting up a fund that did this years ago and has been doing industrial the last 7 or 8 years, but just their bid-ask spread is so high. It's like they underwrite very tightly and they can't find anything. So they're special situations, which is NPLs, taking things back, buying them from banks, dealing with, special credit, groups and special servicers and things like that. I think there's a lot of opportunity in the next 2 or 3 years in that market that you're just now starting to see. In terms of rates of real estate, I mean, I think multi probably goes on a pretty good run again, because I think you're going to see, I think the demand for housing is not going to go away. And I think you're going to see some supply constraints a lot of stuff came online, but it's not going to get built the next 2 or 3 years. So that should present an opportunity 3-4 years from now. And if people can hold on long enough, I think it'll rebound nicely. But I think anybody stuck in variable rate debt right now on value add stuff is getting hurt badly. I think there's opportunities for people to buy, quality, what's pretty quality product at pretty distressed pricing. And we have a bunch of fund clients that are looking at that stuff right now.
It's interesting because I talked to someone recently who was saying, like, the banks are a lot more flexible right now. The lenders are a lot more flexible right now in kind of like helping people get through this. I wonder at what point that no longer becomes the case. Because, like, for example, if you've been in default now and like you're going on like almost a year, like that you're rate adjusted, whatever. Now you're at a year. Like at what point does the bank say, like, okay, it's like enough's enough? Because obviously they don't want to have to no one wants that to happen. But at what point do the lenders say, like, enough is enough? Because I feel like we haven't quite gotten there yet. Like, I feel like there've been a lot of backroom deals that have been happening.
I think that's right. I would say if it's a insured institution, that really comes down to the regulators, right? Because it's all based on regulatory requirements on what they can or can't do. If there's another way the business has changed over the last 10 or 15 years, is there's vastly more non-bank lenders than there used to be, right? So a lot of debt funds that are capitalized separately and don't have the same restrictions that the banks do. They're obviously a lot more expensive, but depending on how they're capitalized, I see them kicking the can down the road too, because they don't want to recognize impairment on these things in their funds if they can possibly avoid it. So any which way they can restructure something with the borrower to avoid having to recognize, that impairment, and hope that they can, allow the borrower to hang on to the property and get out the other side of it and kick the can down the road. I think they'll do it as long as possible. It's just human nature.
Why wouldn't those private debt funds? Because an average, like a normal listener, average listener, whatever you want to say, listening to this, be like, well, why wouldn't they just want to take the property back?
Because the property probably isn't worth the amount of debt that is on the books. And the minute they take it back, they'll have, especially if they're being audited, right? They'll have to recognize the loss at the moment they take that property back. Like, really, they should be recognizing the loss the moment they believe that they're not going to get their money back, right? But most of them won't do that, because then the fund performance suffers, right? And then you explain to their investors why the fund performance suffered, and then it makes it harder to raise capital. So they will avoid, and it depends on the manager, right? Some will do it to the point where they go beyond the bounds of reasonableness, and a lot of them they'll take advantage of the accounting treatment as long as they possibly can, right? Or as long as they have, accountants that will, agree to it. But even then, the accountants oftentimes don't really know. They're not real estate people. So, what's the underlying value of a piece of property? It's what the appraiser says it is, right? Well, an appraiser is looking back in time too. So I think you're starting to see that now, that a lot of the as things transact, the values of the property are coming down, and appraisers now have to recognize that, because now they actually have something to compare it to that would support or show the lower number. So, everything, real estate moves so slowly compared to the rest of the world, right? Things happen slowly. It's like a slow moving freight train that you can see coming from miles away that's going to run you over, but you can't get off the track.
Yeah. Switching gears a little bit, when we're talking to, like, let's say LPs, passive investors, they're those that are listening to this episode right now, there's two distinct models here, right? There's the syndication model, there's the fund model. Obviously, you've had experience, running the fund model. You've had plenty of experience in helping people who have come from syndications over to the fund model. How do you, as a passive investor, kind of make the determination as to whether or not you should be investing into a syndication, like deal by deal, versus just like, Jesus, take the wheel, here's my money, put it in whatever asset or, property you see fit?
I think it depends first and foremost on the needs and the situation of the LP. So I know lots of LPs who are very sophisticated real estate people, and most of them will want to invest deal by deal because they have the capacity to underwrite those deals themselves because they know how to do it. And they want to be able to pick and choose the deals they put their money into because they trust their own judgment. Right. And then they can kind of have more say in it, whereas they don't want to abdicate the decision-making on the investment to a manager, right? Because they feel confident that they can do it. But I'd say for a lot of passive LPs that come from other industries and don't have that real estate expertise, right? Then it's much more difficult for them to underwrite an individual deal and know whether that deal is any good or not, right? Because they just don't personally have the capacity to do it. So unless they've got an advisor that does have that capacity, I would say the diversity of a fund for most LPs affords, generally speaking, it's not as binary, right? In a syndication, if a deal goes bad, right, you can have significant problems, lose all your money, right, or some or all of your money. In a fund, if you have 10 deals and one deal goes bad, right, and it loses all its money, the LP you get a lesser return, but you don't get hit as hard by that one particular deal. So I'd say neither of them, Danny, in my opinion, is inherently good or bad, or one is better than the other. I think they just function differently. And I think different investors should be thoughtful about why they're investing in one or the other, depending on what they're trying to achieve and depending on their level of sophistication on how they would underwrite, a deal or a manager.
That makes a lot of sense. And I would, I would think that the majority of LPs are not sophisticated enough to do a deal by deal underwriting, or to underwrite each deal individually. Or even if they are sophisticated enough, if they're accredited, it likely means that they're quite well off. And if they're quite well off, then they're likely super busy people, unless they're like kind of in that later phase of their career or whatever. And so, like, for example, I think of like physicians, right? Like physicians look a really good, like I always think, whenever I think fund, I always think physicians, because it's like, after you've paid off your debt, which there's a lot of it, right? But after you've paid that off, you're likely raking in some decent cash. And so, but I was surprised to hear, and I've had a couple of other physicians who are now either syndicators and or fund managers. And I was surprised to hear from various physicians how just like financially illiterate they feel like the majority of the physician population is. And I'm sure that that's not just unique to physicians. I'm sure that's true with like a lot of other specialized industries where like you're making lots of money, but you don't really know what to do with it.
Yep.
I
think all of that is true. And I'd say another way that the business has morphed in the last 10 years, especially, I think this is post Jobs Act, is that you see a lot of, I call them tribe leaders or influencers. So you get somebody who used to be a physician, right, who started investing into real estate, found they really loved it. And in fact, they loved it more than, being a physician, and they stopped being a physician and they went out and started doing more real estate. And now they go aggregate a bunch of other physicians and bring those people into a tribe and then, kind of turn them on to the real estate world. And a lot of managers now try to find that tribe leader, because that tribe leader represents a significant point of influence to drive significant investments to a given manager. That happens a great deal in all industries. I mean, I've seen it in, physicians, dentists, engineers. I mean, all different types of professions where people, make good money and need to find a place to put a portion of it.
I like the terminology tribe leader. I think that's a really good way of putting it. And what's interesting is there's so many different silos that I've seen recently where physicians is just one of them. But I know a ex-attorney that was also doing, something like that too. And so, but there's a lot of value there, right? Because they know when you get someone who's been that integrated or that deep into that industry for that long, and then they, get into real estate investing, it is kind of like a lethal combination, especially when it comes to the capital raising component, which is, interesting. So I also know one of my buddies, Justin, he does it for salespeople. So his whole thing is hey, you earn a lot of commission. You're not really doing anything with it. And he was an ex-salesperson. Yep. And I thought that was really interesting, kind of niche, carve out. So I could definitely see that being
salespeople. I mean, attorneys, accountants, engineers, professional athletes, right? Any industry profession that makes good money. You find someone who kind of came into the real estate world and now goes back into the world they came from and helps be a funnel into this world. I mean, that happens way more than it used to, now. And then people try to figure out how do they monetize that business model, right? Because you can't get paid, or you're not supposed to get paid for driving investments to other people unless you're affiliated with a broker dealer and you have, securities licenses to do that. So all different business models spring up where people, charge membership fees or educational components and so forth. And then all of those become sources or leads for various managers on how they capitalize the deals they're doing.
Yeah. It's a really interesting space. And I definitely see it, for all the legalities, right? And obviously you got to make sure that you're compliant, but for all the legalities that are there, I see a lot more upside there than I see downside. I think that overall you're seeing America and society in general just becoming more financially literate through those types of things. You talked about it earlier, right? The information just didn't exist.
No.
When you were starting out, right? You had to,
there was no place you couldn't. I mean, I remember, man, this dates me, right? But in my early days, I would go, Robert Allen was a guy who was he was a pioneer back in the day of people that would talk about how to make money in real estate. Go buy a house using OPM, other people's money, and fix
OPM,
it, right? And there was a handful of those people doing it back then, and now there's just sea of them. It's a whole different world.
It's definitely interesting, and to me, what I'm really curious about is what this space looks like, in 10, 20, 30 years. I don't know, I don't know if all of this information is going to saturate the space, or I'm really curious to see what happens. I don't have any hypothesis. I'm not sure if you do, but to me, I'm just this could go a lot of ways. It could get super saturated, or people will just get exposed for what they really are. And you're still only going to have a certain amount of players because people aren't willing to do the work. They have the information, but not necessarily willing to do the work. So I'm just, it's it'll be interesting to see what happens.
Yeah. And how does artificial intelligence impact the way things are being done I think you're starting to see the impact now on the space. And yeah, it is a fascinating space and a fascinating development of what's going on in the world. I don't know. I don't pretend to have the answer.
Yeah, me neither. So coming back to when you started, because obviously you've been growing this now. So you said 92. So so that's a 3-decade journey, and I'm wondering how many investors have you been able to add to your database in the last the last 3 decades? I'm wondering what that looks like. And then how did you build that investor data? This is a very selfish question, by the way. I'm just curious, how did you do that over time? And what were some of the strategies that you used to build a database?
Yeah, I mean, if I go all the way back in the early days, it was very, very analog, old school. You had to try to figure out who might be interested in these private investments. And it was literally newspapers, Daily Journal of Commerce, finding beneficiaries. And they would publish a list of people who were the beneficiary of trust deeding. Most of the time it was Wells Fargo, Bank of America, whatever. But every now and then you'd see an individual's name, right? And then you'd have to look up the name and then, okay, this person was a beneficiary of a trust deed. Why? Did they make a loan against it? Did they sell the property and carry back the paper? And then you'd have to go try to figure out how to get a hold of that person, which required you to do even more analog work. So, I mean, for years, that was the kind of stuff you'd have to do to try to find it. I think 2013 was the biggest change to all of that. And that's when you started being able to do public solicitation and advertising, right?
Yeah.
The internet had grown far enough along where you could go out now and start doing things publicly and tell the world that you had a fund. Before you couldn't do that. So, I mean, I'd say it's in the thousands. I don't know the exact number, Danny. I mean, and I'd say and I'd striate that by the ones that, there's probably 1,000 or several hundred that we have done a lot of stuff with. And then there's a long tail of people that might have done a little bit or nothing, or have been in the database and acquired, right, that you continue to market to, but it's a fewer, they're not as active. So yeah, it's in the thousands. I'd say it's probably under, of anything that I'd consider more than just, a random list, right? It's probably under 10, but north of 5, I'd say.
Gotcha. That's a very sizable database. And it's what it sounds like is that post 2013, once you were able to publicly advertise, you put some focus and you put some, sounds like, marketing dollars and really started to, create some lead generation channels. Is that what I'm hearing?
Yes. And yes, we did. But I think, there's some of these crowdfunding sites that went out and spent, enormous amount of VC money, acquiring investors. And I believe groups and I've seen some of these and actually looked at acquiring lists over time, and they've got lists in the, 50, 100,000 name range, but we didn't ever really do that. I mean, we tried to keep it tight enough where, I knew that the people were genuinely interested in it and not just, a random list, but it's not random, but so I don't know, man. Yeah. The short answer, yes, we did it analog the old school way. We still do get a lot of referrals from, existing investors. But a lot easier to go out and tell the world that you exist now and try to attract people on the internet. Even that with social media has gotten, you see it on your LinkedIn feed and whatever else, X, TikTok, Instagram. There's just an endless parade of stuff out there anymore. It's like, I'll be honest, man. I lose track of all of it because there's so much of it going on that, it's hard to stay on top of. But the way people attract investors today compared to how they used to do it, very different. I feel like from an investor standpoint, there's a lot of noise, and it's hard to turn between what's worth listening to and what's not.
Yeah, that definitely makes sense. And even in the last, man, and maybe this is just because it's almost like I forget what the law is called, but the law where when you are in the market for a black BMW, then all of a sudden you see a bunch of black BMWs on the road. Yeah. Right.
Yeah. That's the what do they call that? The reticular activating system, right? It's
exactly. Yeah. So
yeah, that's right.
Yeah. So it's maybe that's why, but specifically in the last 5 years, and even post COVID, I want to say really is when you started to see a lot more of that. And that could just be me, I don't know if you've seen it too,
Oh, yeah,
but that's
but I think
my
some of
gauge
that
on it.
too, man, is of course the algorithms of the way all this stuff works is that, I think it makes people more and more myopic because it feeds you more of what you're interested in, right? So you tend to see more and more of the stuff that matters to you and then it reinforces. I mean, like the breadth is less because it's all the stuff that you click on and like, and then it becomes more and more focused, right? Which I guess good, but I mean, is it good? I don't know.
Yeah, who knows? Every once in a while, I'll get served up an ad that I'm like, I'm really glad that popped up, right? But then for every one of those, there's probably like, 40 pieces of garbage.
Exactly.
At least.
It's harder and harder to, there's just so much messaging and noise constantly, and you got your phone in your hand and it's 24/7, right? It's really difficult to not get inundated with stuff, which I think makes it harder to cut through that noise and have a message to people that, they actually care about.
Yeah, no, there's definitely pros and cons. And it's interesting to kind of hear your perspective on that. And it's also interesting to hear how like lead generation or like the ability to lead generate has also like helped you grow the database, because obviously you had a huge base even before 2013, right? So I'm assuming that like, it's not like the database like explode, but like hearing that you already had that foundation and then, put lead generation or like kind of like installed that pillar into the business and that also helped grow it makes a lot of sense to me. It makes a lot of sense.
Yeah. And I think we continue to try to find new ways. I think these days, especially with FundSom, which is kind of our main initiative, finding ways to partner with other groups, tribe leaders, people that have a following, right? And bring value to those people. Right. That's, I think, trying to move the fulcrum over instead of, capturing them one investor at a time. How do you bring value to larger groups of people that already have, because it's a transfer of trust. I mean, that was a great book by Robert Cialdini called Influence, right? It's social proof and the transfer of trust. That's a big way to try to generate additional investors in our database on a going forward basis.
Interesting. Well, Matt, we're coming up on time here, so I want to be respectful of your time. I do have a couple of last questions here, though.
Sure.
First one is for emerging fund managers, someone who's just getting started, wants to start their first fund. What is one piece of advice that you could give someone who is in that headspace?
Make sure you know why you're doing it, and make sure that you're not chasing myths or things that you think are real but really aren't, because there's a lot of myths and misconceptions about running a fund that I don't think people understand. I mean, I use this analogy a lot, Danny, and you might even be too young, but it's like having kids. You can't, until you have had children, you can read all the books you want about, having kids, or you can babysit your niece and nephew, but you don't really know what it's like to have kids until you're a parent, and it's for the fund manager, right? It's like you can listen and hear and listen to your attorney and all that, but until you actually run a fund, you don't really know what all those things are like. So how do you prepare yourself as best you can, before you become a parent or a fund manager? Right, is like that's the best advice I can give them, and I and that's not entirely self-serving, right? Is like, that's what we try to do for managers, is say, hey, like let's here's the real deal, right? So know the real deal, I guess is the best advice I could give.
Makes sense. Well, Matt, you've been awesome, and in traditional Gould Mine fashion, I want you to leave the audience with one final gold nugget.
Yeah, real estate is a great business. Just, if you're going to be in it, pick your lane and know why you're in it and know what you're trying to do, and, and always treat your investors and other people as forthright as you possibly can. So just, be the real deal.
Yeah. Love that. Awesome, Matt. You've been awesome. Thank you so much.
Thank you for having me, man. I appreciate it.